Hello, everyone. Thank you so much for joining us for our first webinar of 2026. My name is Jeremy Cronemeyer. I'm Operations Manager for Wickham Financial Group, and I'll be your host for today's call. Your presenter today will be Graham Wickham, President and CEO of Wickham Financial and Insurance Services. On today's call, Graham will be wrapping up 2025, but also giving an outlook for 2026. And during the call today, there is a Q&A section on the right side that you can type any questions you might have while Graham's speaking today, and we'll try to get to all the questions here at the end. Graham, further ado, I'll let you take it away.
Hey, thank you, Jeremy, and thanks for everyone popping on a hopefully an exciting call, laying out some thoughts, considerations, if you might, for 26 as we kind of wrap up that 25. But let's go ahead and jump in. First off, we kind of tagline this a little bit. We think what's old will be new again. So let's keep that in mind as we go through the call. I'll touch on why we feel that's going to be true, how that can possibly affect the market, your portfolios, so on and so forth. So overall, let's do a 2025 review, kind of look at some indices, returns, some economic numbers here. We'll hit some highlights. We'll look at what's going on for 26, some of the themes, and then some general considerations. But kind of jumping in some numbers. So we ended up with gross domestic product. So that's the growth of the United States that we're looking at. How fast are we growing? Are we growing very quickly or slow? Well, we're growing about 2.4%, is roughly around where we ended up. And that's about average, somewhere between 2 and 3%. It's not a fast growing economy. It's moderating. It's kind of slow here, but it's not too slow from a recession standpoint. It's not too fast where we're overheating. So we're maybe a little bit in a sweet spot where we usually trend. So we're looking at consumer price index. That's inflation, right? Cost of goods and services. We have two different numbers that are usually reported. We'll look at the core number and we'll look at the headline. So what are those two? So the core number usually withholds energy, and I just blanked out. But usually withholds some numbers from that headline number that they like, food and energy. I'll get it right. That they usually feel is a bit more volatile. They strip it out, call it a core number, but usually we still have to deal with food and energy. That's in our everyday lives. So I would encourage just looking back at the headline number at the 2.7%. Keep in mind that 2.7% is a far number from that 9% that we'll illustrate here that we saw in 2022. So we've had over the last few years, really inflation coming down quite a bit. Always keep in mind that the Federal Reserve is always trying to mandate or manage to about a 2% inflation rate. So let's look at the S&P 500, kind of that core indices, 11 different sectors that make up the U.S. economy, that make up the index. That ended the year all in with dividends being reinvested. And that's how we're kind of illustrating everything, not the core return of the index, but we're adding back any income it pays out. That was about 17.9 roughly. Dow Jones Industrial, about 14.9, tends to be a little more value oriented. Then we're looking at mid caps at about 7.5, small cap 6, NASDAQ 20.5, roughly 20.5%. That's pretty tech laden, tech focused area. And then we look at international, the MSCI, that was 32.39%, emerging markets at about 33, really beating the US. That's international markets really outperforming the US markets. Haven't seen that in a long time. We actually think that's going to be a theme for 2026, possibly beyond. And then we saw the 10-year Treasury yield come down and kind of settle in around 4.18%. That was a little bit all over the board this last year. We saw a dip below 4% for a brief period of time, back up closer to the 5% range, and then settle in at a 4.18. So it had some pretty good volatility throughout the year. But let's jump in. What were kind of the sectors that were outperforming? So what we did was we just highlighted the 5-6 top performing sectors and then looked at the 3 bottom sectors. So if we look at the top performing sectors, consumer services, information technology up 33, 24, roughly 0.5%. That's going to be your AI, that tech area that really drove the market's returns for really the first part of 2025. And then the market really started broadening out. And that's where you saw industrials coming in online at about 19 and a half. Financials finished incredibly well and started the year incredibly well for 2026. In the more conservative area, utilities up 13%, and healthcare playing a huge role at about 13. But our laggards here were consumer discretionary, energy, and real estate to kind of round it out. But if we look at what were the leaders in 2023, 24, that was really driven by those two top performing sectors, communication services, information technology, that AI, that top 7 stocks that make up the S&P index. I'll get into that in a little more detail in a minute. But again, they started to moderate about summertime of 2025. The market really started broadening out. So what were the overall highlights? We didn't get into details of, I'm sure you can imagine what these all looked like with the new administration, the tweaks, the discussions, the movements that were going on. Geopolitical events always play a role. We'll highlight what role do they usually play, in terms of market volatility, usually pretty short-lived, even though it can be pretty dramatic at the time that they're happening. And then the Federal Reserve playing a huge role. How much is the Fed going to lower interest rates? How much did they do it in 25 compared to what they're going to do in 26? Well, again, we'll get into that number and our projections for 26. And then the broadening out. We started to see multiple sectors, 11 different sectors that make up the S&P index. But for a good bit there, you saw 1 or 2 sectors that we highlighted as best performers, even for 25. They really drove in 23 and 24, but we started seeing those other, 9 different sectors starting to play a role in this market. And we think that's going to continue. Bonds, boring bonds, you get paid. Maybe we didn't see any big capital appreciation for the core aggregate bond area. But you know what? You got paid pretty good. Look at the money market rates. Move from about, the 5% range settling out the year, somewhere around 3.6, 3.7. The one thing we want to be mindful of in those money market areas, as that Fed lowers interest rate, it's going to be lowering that money market rate that you're going to have. So don't be surprised that helps boost the bond market. Maybe some of that money flows over to stocks. As money leaves that money market area, $6 to $7 trillion sitting in those areas. Imagine that money coming off the sidelines, hitting some other investment areas like stocks, some other bond areas, where it's just getting higher rates of return in conjunction with the Fed lowering interest rates. So we got some real key factors here that could help propel the stock and bond market for 26. So let's jump into that. We think the overall theme for 26 is just going to be a broadening out. We think the old is going to be new again, but we're not going to leave the mindset of what got us here. What got us here is AI, it's technology. That's where the earnings are. That's why the markets were doing so well in a concentrated standpoint for 23, 24, and parts of 25. We don't think that's really going to leave us, but they might just moderate a little bit in their performance. Maybe they move sideways a bit. You can certainly see that in the market so far this year. We'll illustrate that in just a minute. And we think also the market will be helped, and it's looking for, by the way. So we need the Fed to be, maybe the market needs or wants the Fed to be lowering interest rates. How much, how fast, that's really going to be the key. But I think the market's probably targeting or estimating somewhere around two more Fed cuts in 26, maybe the next one coming out in June. Could be sooner, could be more than 2 rate cuts. But just keep in mind, if we are in an economic environment that slows a good bit more, maybe moderates a good bit more, maybe employment moderates a bit, meaning unemployment starts to edge up a bit, that might be more latitude for the Fed to lower interest rates even more. But if we're in a good or growing economy, so we're in a slow economy, but if we're good but slow, if we start to pick up steam, we want to be mindful of how much the Fed really lowers interest rates, because it could do the opposite of what we want it to do. It could spur growth, but also inflation starts to rise, and that could be another challenge for the economy. So the Fed's kind of walking a bit of a tightrope here. But with the administration, we're looking at some core areas. We know geopolitical events are always going to play a role, at least in the psyche, in short-term volatility in the market. but I think it's really going to come down to deregulation. Deregulating, say in the financial industry, I think that can go a long ways to opening up that side of the market to increase profits and revenues and help propel that market going forward. And that's a lot of what the financial stocks, these large money center stocks like JP Morgan, Goldman Sachs, Morgan Stanley, Bank of America, Wells Fargo, Citigroup, those are the largest money center banks in the United States, if not the world. And that's why they've been doing so well. One, because they've lacked so long since 2008. Maybe they haven't fully caught up, but also with this deregulation, maybe an increase in mergers and acquisitions will help the profits and revenues on that side, in turn help the market. That sector has really been outperforming all the way into the end of 25 and into the first part of 26. And then we're getting down to corporate earnings. We highlight that because that's really the linchpin here. As long as we have strong earnings growth, as long as we have earnings growth, I think stocks can follow. But if that starts to falter a bit, and it can falter in some sides of the market as long as other sides pick up, like the old giving up the goat a little bit, or excuse me, the new giving up the goat and returns a little bit, or the leadership, while we have that old economy, more value starting to pick up, I think that's okay as long as we get a broadening out. And if we get earnings increasing, that's what we need for this market to continue to grow. It's going to be the linchpin in this market. Inflation, it's there, but look, it's coming down. 2.6, 2.7 headline on the inflation. Doesn't always feel like it's that low, because I know that certain sides of the market, like housing or consumer, goods like meat or coffee or chocolate, we're seeing spikes in inflation over there. So certain parts of the economy, goods are a lot higher. It's sticky. We've been saying that for years now. You're going to have inflation coming down, but you have certain sides that are going to be sticky and high. That's what we're having. So you're seeing inflation moderate. Doesn't always feel like it is, but it is overall, even though certain sides are staying high. And then the overall growth concerns. Why would I put it out this way? Where we're putting it out this way is that if we are moderating in our growth, which allows the Fed to lower interest rates, but we don't feel like we're going to move into a recession, which is good. We don't feel a recession is going to happen this year, but we do feel we're moderating in our growth of the economy, at least for the first part of the year. That allows employment to moderate down a little bit. Unemployment moves up a little bit. The unemployment rate's about 4.4%. It moderated down for 4.6. That's going to move around a bit, but it still moved up. We just think that that headline might move into maybe from the back of the page to the front of the page and become a little more front of mind, a little more for our pundits to be talking about. And that could just maybe put a little more fear at certain times. Because a lot of what we've seen growth-wise in the economy, even though it's growing good, it's been masked by great stock market performance. If the stock market performance starts to moderate a little bit, maybe that growth concern might be a little more forefront, if that makes sense. Again, not concerned. We're still growing. We don't think we're going to see a recession, but we're not just growing super quick. That's why the Fed can lower interest rates. So let's look at the broadening out. Let's look at what's working and what's not. Remember, we talked about old and new. Let's look at, the equal weight compared to the cap weight index. Let me explain that just real briefly. When we're talking about a cap weight index, we're talking about the S&P 500. And I'll compare that to the Dow Jones Industrial. Quick lesson here, the S&P 500, 11 different sectors, 500 stocks make that up, primarily U.S., some small, mid, primarily large. Use it 30-40% as tech, that area makes up that index. And the higher capitalized companies, like your Apples, your NVIDIAs, your Microsofts, your Amazons, so on and so forth, 7 to 10 of those stocks make up the largest weighting. They've also had the best earnings. They're in tech and AI. That's what's driven this market. At one point, 2023-24, I think we had NVIDIA making up, 14+% of the return of the S&P index. So to say that it was concentrated probably is an understated. We were extremely concentrated, but we're getting that broadening out, and look at that. We saw the S&P index right now up about 1.5%, where the equal weight index. So let's say everything is the same weighting in the S&P 500. So Apple isn't 7%, or NVIDIA isn't 7%. Everyone's the same weighting. Look, it's up 4.8%. So it's really not an argument. It's just a fact. Yeah, we're broadening out. And we'll touch on considerations and thoughts on how you take advantage of that. We are seeing small cap area, the Russell 2000 outperforming up 4% that last part of 2025 compared to just a little bit of a gain for the MAG, 7.3% compared to a negative for the S&P 500. So again, seeing that broadening out, that's continuing for the first of the year here. So let's look at kind of the Fed's effect on some areas like fixed income, right? That's broadening out. So as the Fed's lower interest rates, why would that positively affect fixed income? Well, let's think about it. Fixed income that's being issued out there right now and over the previous years is paying out a higher rate of return from a coupon rate than maybe stuff that's being issued as the Fed's lowering rates. So it's less likely that people want to sell what they have higher returns on and coupon rates for the stuff that's being issued at lower. So you have the selling of the lack of buying for the new, the propping up of the old, and that can help bonds. So you're getting paid a little bit more as the Fed lowers those rates. Maybe we get a little capital appreciation on top of some great income that we're still receiving over in the bond area, especially the municipal bond area. One area that we don't always talk about, but we should in your taxable account, especially if you're in a higher tax bracket area, you can go tax-free with municipal debt. There's a really interesting, and I won't get into it in this, happy to have a private conversation of why, but if you can get 5% tax-free compared to 3.6% taxable, maybe something to consider. Let's jump in here on Fed rate policy and how that affects stocks and bonds and international cash over time. So what we did is we looked over the past 7 Fed easing cycles, and we looked at U.S. stocks. On average, they're up about 27.9%. International stocks are up 27.5, 16 for bonds, and 6 for cash. Now, we're in this non-recessionary cycle that we believe we're in right now. So we're looking for the positive returns from going into an easing or lowering rate cycle for the Fed is happening. It started happening in 25. We think it's going to continue in 26. So we think the top half of the slide's going to happen. But if we do start talking about recessions, well, you're going to have pullbacks. You're going to have pullbacks in stocks. In the more aggressive areas, international will be down 9. On average, stocks are down 3.5. But bonds, those safe havens and cash, they'll be positive. But again, we're looking at the top part of that slide, not the bottom. I know if you've been on our call, you've probably seen this slide used many times. It just works. Geopolitical events, as horrible, as dramatic as they are, as stressful as they are, you know what? They tend to be short-lived. It might be a day, hour, week, month effect, but it never seems to be a long-term effect. And the market usually tends to march on as long as the earnings are there, seems to drive forward. We think that's what's going to happen. As dramatic as we are, I think the market's going to continue to march forward. Here we're looking at corporate earnings. We put kind of a heat map in here with the different sectors. What do we think is going to outperform? We're looking at coming into 26, probably 8 out of the 11 S&P sectors. We're looking at a positive growth rates over 2025. That's well the majority. So we're looking at 2025 at about a 13% growth rate in earnings. We're looking at over a 14.5% projection. Could be higher, could be a little lower, but we're projecting somewhere around that range for growth for 2026. So again, stock prices following earnings. Can we justify the multiples that we're trading at? I think we can, as long as we have earnings there. Because if you think about it, multiples or values of the markets have been a horrible indicator, and that's kind of what we're showing here. So we think that EPS earnings growth on that blue line kind of, has its gyrations, but we think it's probably moving sideways. The multiple will probably stay pretty much where it's at, even though this yellow line, we think going forward, earnings are going to move forward. And if we look at it this way, it might add more volatility to the market, but like I said a minute ago, it's been a horrible indicator of any real correction in the market. you can always expect probably somewhere around a 5 to 10. Usually every quarter you get a 5% volatility in the market. 20% are not as common, even though we had one last year. I'm not going to say it couldn't happen, but I don't think that should derail your long-term goal and objective of your portfolio. Because if you're planning correctly, if you're doing the homework at the beginning with us or whoever you're working with, and we got some individuals on the call that aren't clients, you know what? You shouldn't have to make big moves in the portfolio through volatility. You should have already done your homework at the beginning so you can manage through it and make good business decisions, never emotional ones, when it comes to your portfolio over time. So let's kind of wrap it up with the last couple of slides, so I'll leave some time here for some Q&A. Let's get into inflation. So you can see where our chart here is headline, and then we're showing core inflation. Core inflation is just less food and energy. Headline is adding it back in. The cost of goods and services, I always put it this way, it's kind of like that silent thing that goes on with your investments that we don't always pay attention to. But it always eats away at your return. So we need to be mindful of it and the effect that it has on our performance. But we're illustrating, as in 22, we had about a 9% inflation rate, and obviously it's been coming down. And we think it's going to come down a little bit more, maybe not dramatically. If it comes down dramatically, we might be talking about recessions. Then we're talking about stock market performance that's going to be a lot more volatile than we think we're going to get this year. Not the case. We think it's going to moderate, probably somewhere in this area, even though we think some areas are probably going to continue to stay quite sticky. So inflation, long story short, is going to stay with us, even though it might moderate a little bit more. Here, let's get into gross domestic product, and we're talking about how is the U.S. growing over time. And we have periods of outperformance. It surged about 5.8% in 2021. Why? Well, we had a lot of stimulus coming in. We had the shutdown in 20 and 8 where we saw a real drop. You see those dips in gross domestic product, those lines that kind of dip down. But if you look outside of 21 and that spike that we had, it's pretty moderate, around 2 or 3% growth range. So this is not uncommon to be in this 2 to 3 range, at least what we're illustrating here. So I would temper my enthusiasm that we're going to have some huge growth in the economy any more than I think we're going to have any big collapse coming into 26 in the economic growth. I think we'll moderate in this 2 to 3% range. That seems to be kind of average. So overall, in conclusion, we think we'll have a good market. Maybe it's a moderate returns compared to the 17% or the 20+% that we got in 23 and 24. Maybe we revert to the long-term average of being somewhere around 10% since 1929 or somewhere between 7%. We could always do better than that. But I always think if you temper your enthusiasm, don't look at the past to be a guarantor of the future, then you won't be disappointed, right? So I think it's going to be driven on positive returns. We think they're going to be there. We just think we're going to change the leadership a little bit with the old economy outperforming the new. That might not be a forever call, but it might just be what happens for the first 6 to 8 months of this year. We think the lower interest rates are going to help. Why? Well, that can lower borrowing costs, which leads to profits and revenues for companies that can add back to the bottom line, helping those profits and revenues. We think diversification is going to be key. It's always going to be how you want to manage your portfolio anyways. Don't have all your eggs in one basket, right? But if we're getting into that diversification call, we think international is still going to play a role. We think with the Fed lowering interest rates, international balance sheets, governments increasing their balance sheets, spending more, right? The dollar may be coming down, helping the international markets, maybe emerging is the better performer over developed. We think the small and mid cap area has rooms to catch up to that large. We already saw it's been happening so far this year and into the end of last year. And we think that value, that whole economy area outperforming growth, just rising to the surface. So all in all, we're already seeing this. We're just refortifying at least our thoughts with you that we think that's going to continue for 2026. Jeremy?
Thank you, Graham. So we had a couple of questions come in. So the first one was, should I be concerned about market valuations?
Well, I think it's a horrible indicator of what's going to happen in the short run of the market. I think you should be mindful, right? If we really start seeing a moderation in the economy, right? If we really start to see earnings pulling back, then yeah, I think we really got to be concerned with valuations in the market. But I think we can support it. And also keep in mind, whatever we feel might happen, the market could say oversold or overbought, right, from a valuation standpoint, a lot longer than we're comfortable. So I think right now, as long as earnings there, long story short, we can support it.
Gotcha. Well, the second one I have for you, what areas do you potentially think could outperform this year?
Well, I was highlighting diversification is key on the slide, and I think I don't know if that's still up, that our listeners can still see that, but I do think that international has an opportunity to outperform, because we're looking at a decade plus with international underperforming the U.S. Maybe it's time for international outperform. Why? Well, why would international underperform? We also want to be mindful of the makeup of the international market. It tends to be a little more industrial, a little more financial. They usually are slower growers, trade at a different multiple than a tech-focused economy like the United States that has big earnings drivers through tech. So that's why we can trade a little bit more rich than international markets, higher valuations, and grow more. But I think with balance sheet expansion, dollar coming down, the underperformance, I think international markets still have some room to go. And I think the small and mid cap, maybe it's just a catch-up trade. If we believe the economy is still going to go good, just not super fast. And then I think the value over growth.
Gotcha. I had a question. I know you know it was coming about AI, but how do you think AI, the AI companies are going to affect employment, but also corporate profitability?
I think it's going to be really interesting. I think it's huge. It's obviously something we all have to embrace. We got exposure in it, if we believe it or not, one way or another. It's going to affect our lives. Has it fully been embraced? Has it fully fallen to the bottom line of these companies based on the spend? No, but I think it will evolve. So let's think about this. We're more efficient. Maybe unemployment increases. You're right. But maybe those jobs don't go away. They just go in different areas, right? So we might see unemployment increase for a little bit while we're being more productive, right? We get more of each position out of each man hour. So we can be, profits and revenues can increase. So that can also be a situation where you don't need earnings. This might be an interesting way to think about it. What if we could actually have a moderation in our earnings, but a multiple expansion? Why? Through productivity with AI. So that's another case where I can say we could actually have a moderation in earnings, right? And still have a positive market that doesn't seem overvalued because we have multiple expansion through AI productivity.
Got it. Well, speaking of the AI, talking about that, should we, or our listeners or whatever, should they be having some AI companies in their portfolio in some form or fashion?
Yeah, in some form or fashion, you got it if you like it or not. If you have the S&P index, listen, 7 to 10 of those core stocks, those largest companies, listen, they're AI driven. Either they're producing the chip or they have it on their platform that you're going to enjoy through your phone or Google search or whatever it might be, Tesla cars, I don't know. But yeah, you're going to have exposure outside of just owning those individual names. So again, if you like it or not, it's going to be a part of our everyday. But what I think is the most interesting is not the ones that you hear about the most. It's how manufacturing companies, boring manufacturing companies, utilities, how can they use AI where you wouldn't even think about it to be more efficient, cost positive, productivity positive, that can help out profits and revenues, hence the old rising to the surface compared to the new with AI, higher productivity.
Gotcha. Well, Graham, that was the last question I had, but we always appreciate the information and expertise, and thanking our listeners checking in with us for the first webinar of 2026. We'll be having our second one here, probably close to the end of March, kind of talking about some tax tips and considerations or whatever going into the tax season there. So we look forward to having you on the next call. And also we do have our Retirement Planning Today classes coming up in the next couple of weeks. The first one's on January 27th, which is a Tuesday. And then that next Saturday there too, January 31st. So if you want any more information on those classes, give us a call here at the office or check out our website or our social media pages, and we'd be glad to have you. And we look forward to seeing you next time.
Take care.